Okay, so we're back here with Ecora, with Mr. Marc, and we had the chance to meet in Saudi earlier this year. That was good. And I'm a bit late here with the update, but here we are, and we have lots to talk through here. So I think, Marc, if we just start with H1 in your own words, what do you think? So you just give your general comments on what's happened with the business, and then we'll dig into all the pieces on the chessboard.
Well, I think the real story around H1 was the ramp up in our base metals portfolio. And we've always felt that this portfolio we've assembled has really high cash generation potential. And H1, in many ways, is a bit of a demonstration of what's possible in the longer term from the asset base that we've assembled. For example, we saw base metal revenues up 81% compared to H1 the prior period. And that was driven off of really strong performance from assets like Mantos Blancos, Voisey's Bay, of course, initial contribution from Mimbula. And as we move forward in time, H2 in particular and beyond, we're excited for much more from the producing asset base. And then beyond that, of course, we have the development portfolio as well. So we can speak about that on today's call. And the other thing that we're quite excited about is to have unlocked value in relation to a non-core precious metals royalty. This is an asset that's development stage. It's an asset that within Ecora has always been of a legacy asset. It's an asset that we've always wondered whether we could reallocate that capital, but the circumstances and the market backdrop was never quite right, and we always felt like we could potentially do better in the future. And I'm glad we did, because the result we got, I think, is a very fair one and sees the asset go to a precious metals royalty company portfolio where that royalty arguably belongs. And from the Ecora side, allows us to take capital off the table immediately, reduce drawn debt following the Mimbula acquisition, and in time potentially reallocate that asset and that capital to a commodity or an asset that's closer to our core commodity mix, but also potentially further along the development curve.
Yeah. I mean, and obviously that's the Dugby royalty, and you sold it for $20 million US, which is basically close to 10% of your market cap and cash injection, which is quite nice. I haven't asked you questions about that in the past, so I wasn't able to pick up that was a significant piece of value, and you were able to bring that out of the blue and unlock value. So that speaks to the sort of the depth of your portfolio to some extent, where you're able to pull, I guess, ace out of your sort of suit jacket there, so to speak, which is very good for shareholders.
Well, that's kind of you to say. And, the royalty portfolio in some ways is not just buying royalties. I think Ecora is, at the end of the day, still a relatively small royalty company. And we always do sort of think, how do we put that capital to work, or the capital that we deploy to work in the way that delivers the best ROI? And this is certainly an example, I think, in time where we can potentially put that capital to work in a way that the market at least is more likely to allocate value in the Ecora stock. And as you said, it's a royalty that within Ecora that doesn't quite fit, given its precious metals development stage, and arguably in the development curve further behind many assets we have. The transaction itself, up to $20 million, of which $16.5 million is cash at completions, and we have the balance being contingent payments tied to production. So we still have further upside to come should the asset come into production in the future. But yeah, it's a great result. And it also, I think, just highlights the value that exists in this portfolio beyond the core producing asset base, which suggests that, basically on equity research analyst sort of valuations and some of the parts. So in other words, what is this business worth if you were to add up each individual royalty? The equity is trading slightly for less than the producing asset base. So I think this is a great example, actually, of demonstrating the significant value that exists in the wider portfolio.
Yeah, and obviously Elemental Aldous has been sort of on a rampage in terms of activity. And I guess I'll just give, they're requiring a lot of things. So my gut feeling would be that you're probably getting the better end of this transaction, in my opinion. So I like it. Your unlocking value, it makes sense for Ecora. I guess just one comment about H1. If you would have used to remind people what the actual royalty revenue looked like in H1.
Yeah. So for the period, total revenue is around $18 million. And we report in three sort of segments, if you will. The first is base metals, and that was just under $9 million, and that compares to just under $5 million in H1 of last year. Specialty metals and uranium, so that's basically vanadium and uranium, $4 million, and that compared to $5 million in the period last year. Part of that is volume growth, volume related. Part of that is price. And then the last is bulks and other. And bulks and other is really driven by Kestrel, actually. That's where Kestrel sits, the met coal royalty we have. And in this year, we expect most of our Kestrel revenue to be H2. And last year, most of the Kestrel revenue was almost entirely in H1. So very difficult to do a like for like on periods. But yeah, since you asked, the bulk revenue was $5 million in H1 this year, and last year 41.5. And again, that was primarily a function of Kestrel and timing in our royalty area. At Kestrel, mining returned to our royalty area towards the end of the second quarter. So we'd anticipate Q3 actually being almost entirely in the Ecora royalty area, and then potentially some in Q4 as well.
And we'll get back to Kestrel, but since we're sort of on the subject, what are you expecting for H2, just for reference?
Yeah, so from a volume perspective this year, Kestrel volumes are expected to be slightly higher than last year. But on pricing, obviously, the pricing environment was much stronger last year. So broker consensus for the second half of this year is around $50 million, but that's really a function of the met coal price assumption. And in H1, we did $3.5 million roughly. So broker consensus is somewhere around $18 million for the second half of the year from Kestrel. And more generally, I think we anticipate, as I mentioned, further volume growth in the base metals portfolio. We've seen some pretty strong copper prices. The cobalt price, and we can get into that detail later, has been very strong. So one thing, in addition to the immediate deleveraging impact from the sale of the Dugby royalty, is that we expect to see debt reduce in the second half of this year, following the drawdown in our facility to fund the Mimbula acquisitions, the producing copper stream that we bought earlier this year.
Market cap 350 million CAD currently, or something somewhere on there. And again, we should just briefly reiterate what's the debt and the cash position currently, as people can place these sort of yearly royalty revenue figures in context of what the enterprise value and valuation looks like.
Yeah, so our market cap today is around $250. Our drawn debt, adjusted as of June 30, pro forma for the Dugby royalty sale that we spoke about, is just under 110. So an enterprise value of approximately $360.
Yeah. So let's get into Mimbula, because we haven't had a chance to talk about that. But that was a very nice acquisition. I guess we can just begin with however you like, but I guess talk a bit about the operator and how the deal came together.
Yeah, we're really happy with this acquisition. In some ways, we would say that it's actually almost the perfect next deal for Ecora, and there are a few reasons for that. So first of all, the Mimbula mine is already in production. And therefore, when we put our capital in from completion, we start generating a income entitlement. And that's obviously really positive, given some of the volatility that we just discussed around Kestrel and the ability to create further diversification in our sources of income in the next 5-year period. Secondly, this is a really low-cost operation with a fantastic management team. It's really an example of the type of partner that we look for, and a very resilient operation. The acquisition, as a third point, pushes our copper exposure to just over 50% as a percentage of estimated net asset value. And again, that's based on research analyst forecasts and sort of an asset-by-asset NPV analysis of what our royalty portfolio is valued at. So this acquisition, the transaction, is in many ways, as I said, as I just outlined, a couple of reasons, and there are more, but a couple of reasons we think it's a great fit and a great addition to the Ecora royalty portfolio. The mine itself is undergoing an expansion, a brownfield expansion. So it's historically been built to a nameplate capacity of 10,000 tons per year. the management team last year actually, and again as an example of just the strength of that team, had produced approximately 14,000 tons. So well in excess of nameplate. This is an asset that was brought online in terms of the phase one in a really impressive timeline when you can benchmark that timeline against the wider mining sector. And the management today is expanding the operation from that nameplate of 10,000, although they've been able to push more copper through the circuit, to nameplate capacity of 56,000 tons per year. So our capital in part will go towards funding that expansion, but the Moxico team will also utilize some of the proceeds of this stream to develop other projects in their portfolio. And actually, to pause there, I think actually that really demonstrates the attractiveness of the streaming model in many ways, right? You have a product that allows you to raise capital and redeploy it and effectively capture a really strong value creation between the costs of the stream on a producing asset and the value creation if that capital is being reallocated to developing further assets and moving them forward in the development curve and unlocking value in that respect. It's a very creative way to fund a project. The stream that we have at Mimbula, as you see on the bottom left of this slide, is variable based on the level of copper production. So if you assume 15,000 tons of production, which again isn't too far off what the asset produced last year, our entitlement on the first 15,000 tons is 4.5%. If you run sort of spot prices today, that's not too far away from $5 million per year. And then as the asset continues to move forward in its production profile as it phase two expansion, we incrementally, so on the next 15 to 30,000 tons at our Ecora stream entitles us to 2.5% in addition to the 4.7 on the first 15,000 tons of production. That's an incremental approximately 2.5 million. And then on from the 30,000 level to the nameplate capacity level of 56,000 tons or anything above that, our entitlement is 1%. So effectively, you get to the same place from a cash flow perspective if you were to run 56,000 tons. But the shape of the cash flow profile is a little bit different if you assume different ramp ups. We at Ecora, obviously, as a result of this structure, have slightly less upside on production, but it also means we have a lot less production variability. And that's actually for us really important, I think, at Ecora, particularly given some of the volatility we see around Kestrel. Sort of adding a royalty or stream that has less production volatility while retaining the copper price optionality, we think is a real positive for this business.
So I mean, where are they at currently? For people who don't follow Moxico and what they're up to, they're still private, to my understanding, right? And they're looking to build a second mine in Saudi as well. They're ramping this up. Do you have any information about where they're at? It's a big throughput expansion, obviously.
Yeah, well, it's an SXEW circuit, right? That's fed from an open pit operation. So as far as mining operations go, it's really quite simple compared to, say, an underground expansion at Voisey's Bay, right, where you have 2 declines, 2 underground ore bodies. It's a relatively, from the mining sector, and it's all relative, of course. As far as the mining sector goes, it's much more straightforward. There are a few different requirements to complete the phase 2, but one of them, the first is a larger crusher to feed more volumes from the open pit. And that's been now, at this time anyways, completed and in commissioning. They'll look to expand the SXEW circuit. They'll add more more heaps for heap leaching, and then they'll look to recover some of the fines or the coarse material through an ETL circuit, so an elevated temperature leach that's sort of not too high above ambient temperature, certainly not like an HPAL or something like that. And then with that material then flowing to the upgraded SXEW circuit. So, nothing about this is, in the scheme of things, from a technical perspective, an execution perspective, an operational perspective, anything. It's all been done many times before. And we expect to see a somewhat gradual step up in production volumes. So next year we anticipate production. The guidance we've given, which is somewhat conservative as well, by the way, is 25 to 30,000 tons. And then from there, a full production capacity level of being achieved next year, but perhaps not immediately for the full run rate of the year.
Right. But maybe quite simply, I guess, if you call it 5% of the first 15,000, that's 750 tons of copper. The next level is half, so that's 325. And then the 1% over that, you're 26,000 tons. That's 260 tons more. So you're at 1,300, 1,400 tons of copper that you guys get essentially per year. Do you think, I mean, in due time, sort of the longer time horizon, this is an excellent management team, as you said. Do you think you can get exposure to something that grows into something even grander than that in due course?
Yeah, so the stream after around the first 6 or 7 years, and it depends on the production rate, the stream just becomes 1%.
Okay.
So this structure that we put into place was done in some ways to kind of like front end the cash flows and also reduce the front end volatility of the cash flows. The mine life, as it stands today, is slightly more than a decade, and there are exploration programs underway. So it's very possible that this gets bigger in time. So certainly has the hallmarks of what we look for in royalties and streams, which is a low-cost operation and the potential to run for longer than expected when we transact.
Nice. Okay. I mean, it's a straightforward stream. It's reminiscent to some extent on the Altius Chapada sort of structure, a bit different, but you're doing some similar sort of step down things, which I think is very interesting. So, yeah. Is there anything more we should talk about on Mimbula, or?
I think we covered the big points, Ecora. I mean, if you were to just summarize it, in a nutshell, though, I think we covered a lot of ground. In a nutshell, it's a producing stream, right? So we'll see the benefit of that acquisition we have already this year, and we'll see increasing benefit over the course of H2, simply as a result of a normalized contribution, where H1, it was a stub period, and we really only saw the benefit in the P&L or the income statement from one quarter. So that should contribute to H2, and once we have sort of a steady state, at least from a reporting cycle, and then volume growth beyond that, with a very, very constructive copper price background. I mean, the copper price has moved to today around 10,000 per ton. You're starting to see tightness. Some market commentators are even going as far as to call for a supply deficit in 26. Now, whether that materializes, we'll have to see. But there is a lot of physical tightness in the copper market. It's probably a different topic than Mimbula, but it's sort of interesting to see copper, which is historically traded in line with GDP expectations, be quite resilient. And on the flip side, weakness in the oil price, although there are, of course, some very different drivers of those underlying on the supply side.
But I mean, it seems that this, once fully ramped up at that point in time, about 3 years on non-super bullish sort of outlooks for copper, you'll get payback more or less. Not too. I mean, if you're at $5 per pound, that will be the case. That's $10,000, over $10,000 per ton, and you're gonna do 1,100 going into late 26.
Yeah, if you're running if you're running a copper price in excess of broker consensus forecasts, you could definitely be in the 3-4 years. When we ran the acquisition, we ran it on more conservative long-term copper prices, so it's probably longer on our base case investment numbers. Yeah. But in any event, I think when you look at this, if we paid $50 million for the asset, and at levels that are really not too far from the levels that have historically been achieved. So in other words, if you're assuming the low end of around 15,000 plus or minus, that's not too far away from $5 million, which is an upfront yield of around 5, right? Or 10%, excuse me, which is, fantastic. We think is a baseline of income into the business. It's accretive because this transaction was funded largely with a drawdown in our facility. So, and even then with the cost of debt where they are, the structure results in a transaction that's earnings accretive with the ability to, for the reasons that you just mentioned, really front end and front load the benefit if you see better copper price or better production that's anticipated at the time of the transaction.
I mean, it's clear that it's a very creative investment, but it's also sort of from a portfolio point of view strategically good because most of your big ramp ups doesn't happen in the coming 18 months. They happen in 2.5 years, 3 years from now when they really start to kick in. When Capstone really sort of ramps up all of their assets, gets them going. So that from a portfolio point of view, it really makes sense, according to me as well.
Yeah, well, thanks for that feedback. It's great to hear it. I mean, that's something we really liked about this acquisition, right? If you can add a source of income of revenue for this business at a time where there's a bit of uncertainty on exactly when you see some of the growth in the development stage assets, this just diversifies the sources of cash flow. And as a general point, we hoped, and I think the feedback from the market has supported that hope, that this would be a well-received transaction, and to date it has, which is fantastic.
And before this call, and then again, I hadn't really picked up on this. I haven't paid too much attention on the uranium side of things. But you've had a significant discovery in your portfolio, again highlighting sort of lesser known piece in the portfolio that's sort of emerging and clearly being very valuable for Ecora shareholders. So let's talk about that before we get into the well-known piece on the chessboard again.
Yeah, this is an asset we are delighted to speak about into daylight. It's an asset, actually, interestingly, that is really familiar to those who track NextGen or the uranium sector. Some folks are not aware that we have this royalty, and you'll see in something we speak a lot about to just help educate folks at the market as to what we have here. So the starting point, I think, NextGen is a TSX-listed uranium developer, arguably with what's seen by many is the best uranium project in the world. That's the Arrow deposit, and that project is very, very advanced. The interesting thing for Ecora is this discovery, and what NextGen is now calling the Patterson Corridor East deposit, which, based on NextGen disclosure, is demonstrating very similar characteristics to Arrow as it was as Arrow was being delineated. I think calling the drill hole results and the drilling campaign results at Patterson Corridor East anything other than geologically exceptional is a bit of an understatement. I think we've seen 15 meters at really high grades, mineralizations of 15%, 20%. Some of the most recent holes were off the grade, or off the scale rather, in terms of the ability to record the gamma rays as and when the holes were being tested for mineralogy. So this is potentially for Ecora into the future, of course, but a phenomenal royalty that, much like Kestrel, was acquired for effectively nothing and could be generating a huge amount of income in the future. And I'll give you an example. So Arrow is a deposit which, again, NextGen to date has said that Patterson Corridor East is showing similarities to Arrow. And if Arrow produces 30 million pounds a year initially, just taking that logic to Patterson Corridor East purely on the illustrative basis, 30 million pounds at, call it $100 per pound uranium in the future, at 1%, it implies around $30 million a year for Ecora, which is a pretty phenomenal outcome for a royalty that's not really understood or not really sort of valued in any of the research analysts' forecasts, simply as a result of the deposit being sort of at early stages. So what's next on this one? Well, we're really encouraged by as we'd have to be, by the amount of work that NextGen has really accelerated into this project to further define the deposit. NextGen has completed just over half of a 43,000 meter drill campaign in 2025. And again, with really encouraging and positive results to date. And we're looking forward to seeing, hopefully, a maiden reservist resource estimate in 2026, which will just better help folks understand the potential scale of this deposit, but also from the Ecora perspective, what that royalty entitlement could mean.
Yeah, and I guess for people who don't sort of know the value of uranium, I mean, this is one of these things that there is no comparison in the mineral space of the density of value in rock in uranium. I mean, 15% uranium is worth tens of thousands of dollars per ton in that rock, which, I mean, only tier one gold projects can come close, to my knowledge. But again, the 1 gram per ton is like $100, something like this now. So you would need a lot of gold to get to several tens of thousands of dollars.
Yeah, I mean,
Multi-ounce material, put it that way.
there are deposits in the uranium sector that are measured in parts per million, right?
Yeah, there are.
So here we're
And there are
talking
Athabasca Basin monsters like this.
precisely. So this is a part of our portfolio that, okay, it remains at the drilling stage and delineation stage. So I think it's important to keep that in mind, and it's far from being, a certainty. Um, but from what we've seen to date, it's been incredibly encouraging. And for anyone who tracks NextGen, this is, this discovery is pretty well understood. It's a part of our portfolio that until recently we're working hard at it, but it's not always been the first asset that folks look at in our business. And to some respects, this royalty has been a bit like the Dugby royalty. We own it, just people have not always focused on it.
It is. I mean, it's difficult to make the sort of comparison to something like silicon, which Altius or Origin had, because it's still very early. But point being, and likely, if this is proven out to be another tier one similar to Arrows or Discovery, which maybe they can do in 2 years, if they drill 100,000 meters, it's possible to be able to sort of showcase that's where it's going. Then this thing will likely be transacted, I would presume, from Ecora to some company who really wants a uranium royalty, maybe a uranium-focused royalty company, or one of the bigger companies in the sector, or something. I mean, that would be my best guess, but I guess time will tell.
Yeah, look, I think there's an incredible amount of value potentially in this royalty. As and when this is the first step, probably to really daylighting the value from a market perspective of what this royalty could be, would be a resource. I think otherwise, I think it's very difficult for folks to sort of estimate what it could be worth, right?
Yeah.
But I think it's a fantastic addition to our portfolio in the sense that our portfolio offers growth, as I mentioned earlier, from assets that are already in production, whether they just be expansion or brownfield potential. There's sort of the next wave of growth are from assets that are very much at the front end of the development curve, permitted or sort of at the financing stage. And then beyond that, there's a lot of growth to come into the next decade and beyond. It's really wonderful to have a portfolio today with that type of depth, particularly when you compare this business to what the portfolio looked like, 10 years ago, where it was almost all entirely concentrated in one asset, Kestrel, the met coal royalty, that had a very short mine life.
Again, just to reiterate, in your guesstimation, again, when do you think a resource could be realistic? Is that it would require probably 100,000 meters of drilling or something like that, so maybe 2.5 years from now, or what do you think would be, what could be expected?
Sort of rather than speculate, NextGen has suggested it could be possible next year. So that's certainly our hope. So we'll have to see, though. It's not not something that we can control as Ecora. Obviously, we'd prefer it as soon as possible, but that's not something that we can control. So we'll have to see how NextGen. We'll just have to see how they progress with their campaign and what updates they provide to the market in the coming weeks and months. It does appear to be a real focus for NextGen. It's been really well received by the market for NextGen's world-class Arrow deposit to be potentially supplemented by the Patterson Quarter East deposit, again within very close proximity. If I'm not mistaken, it's only 3.5 kilometers away.
Yeah, so we're adding this to our list of things to continue to check in on now, and looking forward to the resource. Hopefully next year. So I guess we'll move on and talk about good old Voisey's Bay next. So I guess last time we talked, Voisey's Bay was sort of, and it was late last year, wrapping up the underground expansion towards the end of the year. They've done that. They released recently, or you shared as well, the last 90 days they've been sort of running at over 90% capacity at the mill or in the operation in terms of throughput. So maybe just your takeaways, what you see for Voisey's Bay going into H2 and sort of the expected delivery sequence as well.
Yeah, well, we've been really excited to see Voisey's Bay accelerate with a very steep sort of ramp up profile following the completion of the project last year. This is an asset that has so much potential from a cash generation as a cash generating contributor to our wider portfolio, and I think as a result of the underground expansion being delayed, we just really have not seen what really the potential of this asset, and we're delighted to see that start to come through in the first half of the year. You can see on the slide that we've included here an H1 copper streamed entitlements to Ecora of 140 tons. Already, actually, in the first two months of the third quarter, we received 140 tons under the stream. So in other words, in the first 2 months of H2, we achieved what we had, the entirety of the first half of the year. And on the back of that, we had the confidence to upgrade the low end of our guidance for the year from 365 tons to 390 tons. So for H2, that implies 225 to 250 tons to Ecora. There will be some maintenance at the Voisey's Bay mine and at the Long Harbor refinery in H2. So we're certainly not expecting sort of the performance that we've seen thus far into Q3 last for the entirety of the second half of the year. But it's just absolutely wonderful to seeing this asset really ramp up and starting to see much stronger volumes from Voisey's Bay. And it gives us a great line of sight into next year, where Vale is targeting full production capacity, achieving full production like steady state run rate at Voisey's Bay, which implies over the life of the mine an average of 560 tons a year, which you can see on the left what it is on a half yearly basis. So yeah, it's a strong place to be, I think, with Voisey's, and particularly given the sort of stronger price backdrop we've seen. Voisey's Bay thus far this year has certainly been surpassing expectations.
So operationally going very well. Again, cobalt prices are high or higher. They've increased against 50% since early this year. So now sitting at I think close to $35,000 per ton or somewhere slightly below that, but still that's a fairly nice uptick in cash flow output. So 550 tons per day starting or per year starting next year, and you multiply that by whatever price you would like to see with current spot at over $30,000 per ton, gets you 15 million. I guess that should work out to per year, which is a lot.
Yeah, and important to keep in mind that at Voisey's, Ecora primarily receives alloy grade. You can see on the left here what we've received in the past, the split between alloy and standard. Historically, it's been around 80% alloy grade, and H1 actually it was all alloy grade. On the right, you can see the price differential between alloy grade and standard grade. So the alloy grade price has been, since March-ish, somewhere around $18 to $20 per pound in that sort of range. So we're receiving higher than the posted LME price. And forgive me here, Gordon. And I do think in kg. Yeah, I think on cobalt, anyways. I don't think in kilograms. I think in pounds. But yeah, so if you do approximately $20 per pound at full production, that's approximately $20 million in EBITDA to Ecora.
Yeah, it's a very, very good one. And this year you expect ore stream. This year you're expecting 350 again, so that's still a lot of money. Very good.
Yeah, so 350 tons, and that's the low end, right? We upgraded our guidance to 365 at the low end, so it was 325, and now it's 365 at the low end, and yeah, it's just great. It's really quite pleasing, frankly, to see this asset really sort of demonstrate on its potential. And as I said, we at Ecora have always known what it's capable of and how meaningful as a contributor it could be for us. But as a result of the delay in the underground expansion and ramp up of production thereafter, it's just something that we haven't been able to show the market. So it's great. It's great to be where we are, and this is an asset. I think beyond the current ramp up, there does appear, in our view, anyways, to be potential to potentially see production increases, just an increase in throughput capacity into the future. but most beyond that, life of mine expansion potential. This is a big stream area. The prospectivity of that region is really attractive. We don't think when we sort of look at what could be possible, and we wouldn't expect the market by any means to value this, but is that a doubling of the mine life is very possible here, just given some of the prospectivity in the region and the size of the stream area. Yeah, and the other interesting thing when you think about cobalt is just price, right? I mean, cobalt, the starting point at the beginning of this year was the lowest cobalt price in real terms in 50 years. So a cobalt price of, on the alloy grade anyway, somewhere around $18, $19, $20 per pound. You kind of put that in the context of historically the lows of around 13 and the highs of 40. So the cobalt price has certainly improved, but by no means would I characterize the price today as being at sort of elevated levels on a cyclical basis. And the other thing that we continue to see, and that's expected, is fairly strong demand growth. Cobalt demand last year is estimated to be in the high single digits or low double digits, depending on which market assessment commentator you look at. And certainly the story around cobalt last year was very much on supply, although that was clearly concentrated in one asset with one owner. So having some time for the sort of market balance to sort of catch up, but also just to see organic demand growth is, I think, longer term still points to there being price potential far beyond current levels. As anything, as you know, Gorm, the beauty of the royalty model is for the long mine life, you have the possibility of capturing many price cycles, and thus potentially outperforming, which is the point.
Then again, you're quite evidently not paying a big premium to that for your Voisey's exposure, which is a unique situation where you're able to actually get a very fair or discounted valuation exposure to that alone. So that's honestly quite incredible, but that's where we're at.
Yeah, our long-term price when we acquired this stream was in the low 20s. And if you were to go back and sort of calculate the weighted average price we've received to date, actually we're kind of tracking right around those levels. So, I think it's an example of, like, the past few years have clearly been disappointing on the cobalt price. But if you go a little bit further back to 2022, cobalt was $40 per pound, right? So I think when we think about cobalt and we think about this asset, we really do take a 20-year view, for example, right? And in that horizon, it does appear that we have better price upside given that entry point, which is the same logic I think you're making as well from when we bought this asset, but also for an investor coming into the Ecora stock today. The question is, do you have asymmetric price upside on this and other assets in the portfolio? And we'd argue this example that we're discussing here at Voisey's applies more broadly to the Ecora equity investment.
That's enough for Voisey's, I guess, for now. So we should check in on Mantos Blancos again. Last time the ramp up is undergoing. We should check in on how it's proceeding. I recall we were expecting the feasibility study towards the end of 25, outlining one of the additional expansion scenarios. So I'll just let you start with what's happened in the last few quarters and what's the immediate catalyst and expectations, and then we'll talk again and just look at the impact that the asset will have to Ecora.
Yeah, there's a lot to be happy about likewise at Mantos Blancos, in a large part as a result of the operational execution from the Capstone team. It's been wonderful to see the asset as a result of actions taken by Capstone in last year. See the benefit today where the mine is now on the sulfide circuit anyways, producing generally at or above nameplate capacity levels. You can see that on the left-hand side of the slide. As a result of the operational performance and copper price, we've seen now 3 consecutive quarterly records of royalty income to Ecora. In H1, this royalty generated $3.8 million. And this is an asset we've always known that could do more, and we sort of spoke about the capability of this operation just from where it is today to do more. And I think if you were to go back and look at our prior video and watch this video today, you really see that execution having been delivered by the team at Capstone, which is encouraging. So what's next here? Well, next would be the phase 2 brownfield expansion study. and that has been delayed to 2026. But it's potentially gotten broader as a result of that study, potentially including the ability to reprocess waste material. So why don't we just take a second, Gorm, and go through what phase 2 is and what it looks like and what it means, and I think that maybe
Let's do that. Let's do that. You even mentioned this potential last time I recall, so let's go through it again. And now it looks like that might be the scenario playing out here, so that will be good.
Yeah. So phase 2 has two sources of potential incremental copper production. So the first would be to increase the sulfide circuit's capacity from 20,000 tons per day to 27,000 tons per day. And if you're not totally familiar with that verbiage, what does that mean? It's potentially 10,000 tons incrementally of copper from the sulfide circuit. If you run our current royalty entitlement at sort of spot-ish copper prices, that's incrementally something like $1 to $1.5 million of royalty income to Ecora. The second source of potential upside is through the retreatment of waste material that's through an existing SXEW circuit that has excess capacity. And that could run for approximately 14, 15 years. Capstone has suggested it could incrementally add 25,000 tons of copper per year. If you take 25,000 tons from the oxide circuit at our royalty rate, that implies approximately $3.5 million per year. So together, that's a potentially $5 million per year on this royalty. And when you think about the likelihood of these projects, of course, it's hard to say without access to the feasibility study. But one thing that Capstone has always spoken about in the past is that they would look to use a lot of existing or underutilized equipment for phase 2. And what that suggests is that the phase 2 expansion could achieve really high return on invested capital as a result of the low capital intensity of this expansion. And these are really the types of projects that mining executives love in the mining sector. And if you have the ability to drive increased production for fairly small upfront amounts from a greenfield project comparison, these are the types of projects that are often prioritized. So it's something we're keeping a close eye on. But yeah, I think it's an area of our portfolio, again, to come back to a point I made earlier, where we expect further growth potential in the brownfield sense from assets that are already in production. And again, that's all within the dimensions of one, just growth from volume growth from assets that are already in production, the brownfield expansions from assets that are already in production, and then the third area being assets that are greenfield coming into production.
So just a quick reminder, the current copper output that it's been doing in the last sort of 3 quarters, they're ramping up nicely, but what's the actual output?
Yeah, so Capstone this year has guided at the midpoint for this mine approximately 54,000 tons.
Yeah.
And the impact of phase 2 in aggregate is potentially, as indicated by Capstone disclosure, 35,000 tons a year. So effectively what you could see is an asset at 54,000 or 55,000 this year, potentially up to 90,000. That's not certain, of course, and we have yet to see the feasibility study for phase 2, but obviously that's a potentially meaningful increase in copper production, and it's something that we're tracking very carefully, and we think any Ecora investor or prospective investor should be interested in tracking as well.
Yeah, I mean, it's very nice to see the existing assets expand production like this. Is very, and as you say, it's something that sort of happens as well. I mean, Capstone has investment alternatives in their portfolio, and you're exposed to many of them. But this is prioritized because it's low capex. It's next to teams, next to operations. It's easier to do. So it's very good. Did they indicate any sort of indication of when in 26 this would be released? The delineation or outlining of this scenario? Will it be sort of H1 or Q1 or any comments there?
Yeah, I expect it to be a bit tighter as you get towards the end of the year. I mean, it's very possible that they'll firm up guidance in their Q3, which is only a couple of weeks away now. So that's probably, if not then, I expect more at the time of the Q4.
Okay. I guess we should move over to Kestrel as well. We mentioned that briefly earlier, but just again, a reiteration, H1 was known to be weak because they were not in the royalty area. In H2, they're expected to be almost, or in Q3 specifically, almost fully in the royalty area. But you did quote 50 million US consensus forecast for H2. Was that for the entire year?
No, that's for H2. So the Kestrel entitlement, again, which is really a stub period of Q2 when mining moved back into a royalty area. We saw that 3.5 roughly contribution in the first half of the year, and analyst consensus is around 15 million for H2. Met coal prices are cyclically fairly weak at the moment. The spot price for the Aussie FOB price today is around 180, 190 in that range in the past couple of weeks, and that compares to a price level in excess of maybe 250 last year. So that comes through, and I think you see the impact of that on the expected contribution this year. I think what's interesting more generally, though, when you look at the met coal market in the next couple of years, is the policy in China around what they call anti-involution, right? The idea of reducing competition for the sake of competition. And that's come through in the met coal market. You've seen some reductions in production capacity. You see it a bit in permitting. There has been, that's a bit of a green shoot, I think, for the met coal market, because ultimately, if China exports steel, and they do so based on met coal produced domestically or in Mongolia, effectively they're also exporting to the world met coal. And if China cuts back on met coal production, even assuming constant steel, then obviously that's positive for seaborne demand, right? Or if they cut back on steel as one leg further, then effectively that means that the world is using more coking coal if all that steel is produced somewhere else in the world on the seaborne market. So all in all, there's some, as you sit here today, there are some green shoots in the met coal market, and we'll just have to see how quickly, if any, that comes through in the second half of the year and beyond.
And what's just a reminder, what's the expected volume if we look at next year, 26?
Yeah, the guidance into the market is approximately half of what we have this year, but that's something that will firm up as and when we get to the end of this year, when we have better visibility into the mine plan as provided us to by the actual mining company.
Okay. So if we move over to Santo Domingo, obviously here we're waiting for, or at least last time we were waiting for a communicated sort of timeline on construction. And sometime in 25 we were expecting that. I guess what's the latest there? Is that very imminent now, or what's your comments?
There are two big updates there. The first is that Capstone is seeking to bring in a partner at the project level to part fund and the development of this project, and that's a cookie cutter approach to what Capstone did at the nearby Manto Verde mine in its development. So that's something to watch. Capstone in parallel has been progressing detailed engineering, and they've sort of guided to that in their disclosures, where more detail is available if someone's keen to get a feel for the CapEx spend. With that front-end work that they've been pursuing, Capstone has stated that the asset would be in an FID-ready position sometime next year. They've not yet guided on the FID decision point. So, from an Ecora perspective, the three big events are probably, number one, a minority partner, number two, an FID decision and the start of construction, and then number three, first royalty income.
Yeah. And the things moving into getting it financed and getting the partner and so on, do you expect that to happen sort of before the end of H1 next year? What's your gut feeling? Just your analysis of the situation.
Yeah, I think it's hard to predict without knowing who the minority partner is, right? Because that minority partner could, in and of itself, open up financing options that may be different depending on who the partner is. Yeah. So the other thing that Capstone has spoken about is a desire to see their own net debt levels come down following the Manto Verde expansion. Yeah. So part of the calculus is, well, are you constructive on copper, right? If you carry forward copper at $10,000 per ton, that probably brings down the net debt levels of Mantos Blancos, of Capstone Copper more quickly. And number two, depending on the partner, that could open up other sources of financing. So I think where we sit today, given this asset in our portfolio appears to be valued close to with a minimal value allocated to it, I think just in the first instance, seeing a demonstration of the value that could exist in this royalty by virtue of bringing on a partner is in of itself potentially a value catalyst for Ecora.
Yeah, I mean it's what's the projected capex for Santo Domingo?
Yeah, so I have some figures here for you, and why don't we
Yeah,
just go over as a refresher all of the figures. So this is a 20-year mine life,
yeah,
but our royalty area covers initially the first 6 to 7 years of the ore body, and that's basically the highest copper portion of the ore body. And then mining operations materially move back into royalty lands at Ecora sometime around year 14. Capex for the project is estimated at 2.3 billion. The operating costs are forecast in the lowest quartile of the global CU cost curve, accounting for byproducts. And the asset is expected to produce just over 100,000 tons in the first, on average, in year 1 to 6,
okay,
approximately 35, 36, 37 ounces, 1,000 ounces of gold per year, and then 3.5 million tons of iron ore per year. And then again, at spot prices, that's somewhere around $30 million of royalty income to Ecora during that period annually.
and Capstone I just checked here, they're trading at 8 billion Canadian market cap. They have a debt of basically 2 billion Canadian, at least it's the end of Q2. Net debt of 1.5 billion, so 1 billion US. So I mean, they have some leverage, but it's not like they're extremely over leveraged. Have they indicated some specific leverage or debt ratio they want to maintain, or anything like this we can sort of think about?
No, and I think that's an important point, Gorm. By no means does Capstone, or do we think, or does the market appear to think that Capstone is sort of overly levered.
Yeah,
But I think it's all in the context of having recently financed the Manto Verde expansion, right?
excited.
So I think it's about making sure that that's well and truly running, seeing the debt come down on the balance sheet to provide more flexibility before starting a new project. So I don't, it certainly doesn't appear to be an issue from the starting point. It's more so about, as guided by Capstone, taking on the development of a new project from a position of strength
Yeah.
and having some flexibility.
Well, it seems quite clear that this will be built. It's just sort of that they're electing their timing here wisely, I guess. Uh,
Mm.
and the team, as we've seen, has been very extremely competent in executing builds and expansions and so on. So, yeah, it's the market not assigning much value to this to Ecora is an interesting situation. I guess it's
Yeah,
your especially once when it's completely clear it's going to get financed. They have a partner in there just to get the analysts up to update their projections and models.
so many analysts do include this royalty. I think
Okay.
what's a bit uncertain is exactly the when, right? Is it, and what then when you compare the royalty, the value of each royalty as estimated by analysts,
Hmm.
um, and then you add the value of the royalties that are not yet in production, the share price today just suggests that the market is not pricing in the development stage royalty portfolios. Um, so
Yeah.
I can actually illustrate that point a bit more easily. So it's a question of sort of what's priced into the core equity, and what you can see here is the value as estimated by research analysts of our producing assets. That yellowish line, you can see what assets are included in the near-term development of 73P as estimated by research analysts. There's a list on the right, and I guess that's the point, I suppose, is from a market perspective and as an investor perspective, these assets don't appear to be allocated to be valued at the price today, which in other words does appear to offer a lot of upside value to these assets, and thus, given there's not much value apparent that appears to be in for Santo Domingo today, bringing on a partner surely is really, really good news in terms of this asset potentially coming online.
Yeah. And maybe you're closer to this now than most, but many royalty companies trade at a premium to NAV as well, at least sort of calculated on known information. So, in your immediate peer group, I guess there could be more captured than just getting to NAV sort of fair trading value, which over time, obviously, that's the point of the royalty model. It sort of checks out to make sense that actually these things should command premium to NAV.
Yeah, I think so too. And Ecora is, you have to kind of look at what's happening at Ecora, right? Ecora has come from being almost entirely met coal. It's that the steel making coal royalty is running off. You have new royalties coming in. Some of those are ramping up. I think this business is going through a pretty major transition, and plus you overlay the volatility of the commodity price cycle. So I think all of that is sort of feeding into what exists today, whereby you have the share price potentially not reflecting the true value that's in this company. And part of that, I think, as well, is Ecora at times does feel like it's seen by the market as for what it was, which is sort of a runoff met coal royalty, and not for what it is, which is a really high growth critical minerals royalty with most of its assets in copper, actually. And that remains the opportunity for investors who are keen to get exposure to the royalty portfolio we've assembled.
But I mean, sort of when I monitor your activities, I've seen some things where some people like Rick Rule, for example, are getting interested. He's invested personally, and he's communicating this case in his fairly large networks as well, which is a bit of it's still early, but there seems to be sort of a bit of a narrative turning point unfolding, which wasn't the case a year ago, I would say.
Yeah, and I think in some parts it's like met coal is just out of fashion, right? I mean, met coal is not something, there are many folks who cannot invest in it as a result of restrictions from an institutional perspective. And as a result, it sort of means that it kind of appears that some folks might be missing some of the growth that exists in this royalty company. That's certainly the narrative I think that Rick Rule has taken with regards to Ecora in some respects, to paraphrase it. But in terms of the inflection point, yeah, it does feel like we're sort of moving forward with this business, particularly given the performance of the assets that are expected to produce for decades into the future, right? And that's the interesting thing about Ecora, I think, when you sit here today is, in the past, Ecora was always a business tied in Kestrel, right? One asset with a mine life that you measure in years. And as we sort of demonstrate the earnings potential just from the assets that are already in production, that the quality of earnings of this business change from sort of years in one commodity to decades from a multitude of commodities and counterparties. It's immeasurably better, and it's exciting. I think it does appear we are approaching that inflection point where Ecora is perceived and valued differently.
And obviously, I would assume that the analysts don't value things like PCE, the uranium discovery, yet at all, or have any of them assigned any value to it. I guess it's too early for them to do so.
Yeah, that's absolutely correct. So we spoke about the Mantos Blancos Phase 2 expansion. The analysts don't allocate value there. I think they're waiting to see the study. Patterson Quarter East or Next Gen Royalty, likewise, no value allocated. So I think for any investor looking for exposure to this suite of commodities with the counterparties we have, you have what appears to be a great entry point and a lot of upside, given the development portfolio does not appear to be priced in.
Okay, so let's finish our asset dance here. I think next up in queue, I think I would go with Piaui before Maracas Menchen. And Piaui essentially received a loan letter of intent from the U.S. Developed Finance Corporation, which would be 40% of the financing package, a total of $550 million US. I mean, first of all, what does this mean, really? Because I've seen some of these, one previously, I think, but it wasn't clear exactly is this like a firm commitment, or is this more of a backstop to other lenders, or what's your interpretation of what that actually means?
Yeah, well, it's not committed at this time, but the capital would be sort of funded and agreed directly with that agency, right? So I think that's a really positive indication of support from the U.S. government indirectly with the DFC, who's already actually indirectly a shareholder of this project, right, via TechMet, and it de-risks a huge portion of the capital structure. The challenge a little bit around developing a nickel project today is just generally market sentiment, which is quite weak, although that is starting to turn in part as of what we're seeing in Indonesia. But I think it's a great sign, and it's a great validation of the really great work that the team at Brazilian Nickel has done. I mean, the team continues to persevere and push forward with the project development. I think from a technical perspective, we've been delighted by the work that they've completed to further de-risk this project. From an operational readiness side and project execution, the hirings that have been made and the level of talent that exists at Brazilian Nickel is really impressive. So I think it's a type of asset that, when nickel outlook and the nickel market is cyclically so weak, it doesn't get a huge amount of focus. But that being said, it remains one of the best undeveloped nickel projects, in our opinion, that exists from a cost perspective and a jurisdiction perspective. That is possible of producing even profitably from a cash flow perspective, even at today's weak nickel prices.
So what's the next steps here? What are you guys looking out for? What are they sort of waiting to get more constructive on nickel to be able to pull the financing through, or what's the outlook?
Yeah, probably from a financing perspective is twofold. It's the equity piece, and the company continues to engage with potential partners, strategics looking for security of supply. How quickly that moves, it's a bit harder to measure. It's probably somewhat correlated by the general sentiment around nickel markets. But yeah, the company is very active in those discussions, which is encouraging to see that level of interest, even in what are weak nickel price environments. And second, progress on the debt side with the DFC.
Okay, so a bit unclear, but if I would sort of ask you, and this is obviously your opinion, and you're not the CEO of Brazilian Nickel, but in the coming 12 months that they actually construct a financing package, what probability would you assign to it? You think it's weighing towards being over 50%, or what's your gut feeling?
Yeah, it's certainly possible, but I think a lot of it is tied to the nickel market, right? And I think, what's happened in the nickel market? Well, you now have Indonesia producing almost 70% of the world's supply of nickel. A lot of that supply, not all of it, certainly a lot of it, is indirectly funded and owned by Chinese operators.
Yeah.
And you have another market, like many in commodities, that is, in some respects, an oligopoly, near monopoly in others, and controlled in part by SOEs out of China, which politically and geopolitically is in today's world not hugely desirable, right? So you also overlay that with the Indonesian government increasingly being restrictive on ore mining permits. If you look, the latest news is fairly meaningful. It's a change from 3-year permits to 1-year permits, in part to better manage pricing, which is definitely achievable if a country is responsible for 70% of the world's supply of products. And you're starting to see ore shortages actually in Indonesia from domestically produced ore, with ore imports to feed the downstream capacity that's been put into place. So I think in a long way of saying, I think the probability you assign to this project in the next sort of 12 months is a function of ultimately how quickly, or if at all, the nickel price recovers. Okay.
So it's a very nice nickel option, and maybe we can just sort of remind quickly what the impact actually would be at some nickel price. You can elect which one, or what sort of production exposure you guys actually have based on their latest study.
Yeah, so we have a royalty today that is 1.6%, and then we have the right, but not obligation, to part fund the construction of the project for the acquisition of incrementally 2.65% royalty for $62.5 million. So we're at 1.6%, and for $62.5 million, we could take that up to 4.25%. And then at the 5-year average on our core, if you were to take the 5-year average production profile of nickel and you run the long-term nickel price of 18,500 per ton, that implies around $7 million per year. And if you were to take the larger project, the larger royalty entitlement, so you were to assume that Ecora funded the 62.5 million to take its royalty interest up to 4.25%, that would be around 18 million.
Yeah, so another one of these sort of 15 to 30 million range assets potentially, although you need to make incremental investment, but still very interesting.
And I guess that's the key point, right? The incremental investment is not a fixed obligation on Ecora. So balance sheet perspective, if that growth makes sense at the time, you would consider it. But if you've pursued other acquisitions in the interim, or it just doesn't appear prudent, it's not certainly an overhang or a fixed commitment of funding that exists for Ecora.
Yeah. So if we talk about the other piece of the chessboard Maracas Menchen, so I think the big thing that has happened there, they basically just massively increased their mine life. Maybe you can just talk a bit about that and how you're thinking about that asset as well.
Yeah, this is an asset that has just consistently gotten longer from a mine life perspective. So if you went back in time, so the 2016 study had it at 15 years to 2031. And the 2021 study had it 21 years to 2042. And the latest study that you refer to has it 31 years to 2055-ish. So, it's really delighting. We're delighted to see this asset deliver on what we always considered to be the case when we bought the royalty, of having strong life of mine expansion potential.
And do they have any plans on adjusting output of the asset based on the bit longer mine life?
Yeah, so the grade profile as they've extended, head grade does appear to come down. So there's a sort of detailed schedule in the 43-101. If your viewers want to have a look, it's figure 1-1, where you can see sort of a LOM production rate from a tonnage perspective. But generally speaking, right, sort of more production for longer is a good thing as a royalty holder.
Okay, so no plans communicated by management to upscale throughput to compensate for slightly lower grades over time?
Yeah, no, that doesn't appear the case, but it's certainly possible in the future. Okay. It doesn't appear to be sort of the base case today anyways. There is optionality longer term in terms of taking an ilmenite product and taking it to a TiO2 pigment product. That optionality exists as well. Although again, it doesn't appear to be factored into the base case as of today.
Okay. And just a quick reminder, what's the sort of contribution? Maracas is a bit of a smaller one compared to some of the others, but reminder of the contribution at NSR. So.
Yeah, so this royalty has sort of moved over the years, and cyclically speaking, today we're probably at a weaker point in the vanadium price cycle than where we've been. Well, if you were to take a 10-year view from the time we've owned the royalty. The royalty in H1 generated just under $1 million for Ecora, and that was off volumes that historically were sort of towards the low end of what this asset can do. So you'd probably, if you looked into the future, take a view, to give you a bit more detail here. This asset historically has done on average around 10 to 12,000 tons per year, and sort of sales guidance for this year are 7.5 to 9.5. So this is probably not the strongest year for Ecora, but it's tracking around $2 million this year, and certainly offers a lot better performance through price recovery if you look through cycle.
And the vanadium price, for people who, I guess most people probably are not aware, is that like $5 per pound now, or $4? $3, $4?
Yeah, right around there. Yeah, exactly. So cyclically, if you were to take the low vanadium in the past 10 years, maybe is in the threes, so $4 per pound, and the high is above $30 per pound. The price today, V205 is around 5-ish. But Largo receives better pricing than the posted VO205 price, in part because they produce really high purity or high spec products. So they receive better pricing than what's sort of the posted V205 grade, as quoted on fast markets. And
the vanadium market is small globally, like $4 billion US globally per year or something like that, right? It's not very big.
it's a small market, but it's a vital market. So
Yeah.
vanadium is used as an alloying agent to strengthen steel, which is
Yeah.
obviously crucial in any sort of modern economy from a construction perspective. When you think about just having high quality infrastructure or resilient infrastructure, but also from defense perspective, obviously it's a key input for certain strengthened alloys in that sector. And from a growth perspective, you're starting to see now more meaningful pickup in vanadium redox flow batteries. So the majority of demand has historically been steel. The fastest growth area of demand from a small base has been the stationary storage for vanadium redox flow batteries.
Yeah. And I guess we should check in on good old Phalaborwa as well, which was the acquisition prior to Mimbula. How's things proceeding there?
Yeah, we've been really happy with how things have been proceeding, actually, for two reasons. First, from a more geopolitical point of view, if when we acquired the royalty, one of the things we spoke to was the fact that almost 90% of magnet supply today in the world from NdPr magnets, anyways, or refined or separated rare earth oxides is from China, and that's just appeared to be unsustainable and a very uncomfortable position, I think, for governments in the West. We always saw the potential for disruption. And when you carry forward a year later, last summer we saw a number of auto manufacturers potentially almost come close to shut down production supply lines. And now I don't mean EV production, I just mean plain old combustion engine vehicles, right? Because of restrictions around the supply of rare earths from China to the world. So it's, the imperative for the West to develop alternate sources of supply is clear. And I think it's really been demonstrated. We haven't seen the full impact potentially of what would occur to Western manufacturing should China really restrict the supply of rare earth products to the West. But what we have seen is a pickup in pricing and a greater appreciation for the need to have alternate sources of supply. And that includes the US governments via the DoD, the Department of Defense, investing directly into MP Materials, the owner of Thacker Pass rare earths mine in the United States, becoming the largest shareholder in that business, and also an offtake deal with a price floor of $110 per kilogram for an NdPr product. NdPr products are key magnet making, permanent magnet rare earths. So all this backdrop is just really positive, I think, for the general outlook and also for the likelihood of Rainbow Rare Earths Phalaborwa project coming online, in part because the US government already indirectly is a fairly large shareholder of this project and the parent company at Rainbow Rare Earths, but also at the project level via TechMet.
So that's a very good sort of higher level outlook. But if we just look at the asset moving into actual construction and so on and these steps, what's the latest take on that, or what's the outlook?
Well, that was part two of my answer, Gordon. So that's the macro backdrop, I agree. And then the other thing that we're quite happy as well is exactly that, the technical side.
Yeah.
Since we spoke, first we saw an updated study in December 2024, right, where you saw CapEx go from slightly just below 300 million to slightly above 300 million, which in the inflationary environment we find ourselves in is something we've been really happy about. You saw some level of cost inflation on the on OPEX, but even then, the project still remains one of the highest potential margin producers of rare earths globally, outside of China. Most recently, we saw the company publish details in relation to some test work where they had using like a continuous ion exchange in the front end production at a really high purity, right, higher than 55%, an MREC, a mixed rare earth concentrate product. And that's without pulling back on the recoveries, which is even more impressive. So we're really happy about how the project has been progressing from a technical perspective. And the next key sort of technical milestone for this project is the release of a definitive feasibility study. And that appears to be based on the Rainbow Rare Earths disclosure progressing well and expected to be released in H2.
Do you expect, sort of from the last economic study, do you expect any significant design changes in terms of scale of production, or is it mostly optimization in terms of recovery, flow sheet, and engineering or do you expect any design? They indicated any design changes?
Yeah, they've definitely spoken to initiatives that could potentially bring down capex on the front end, for example, in the update I referenced around the product purity. Also, some work being done that could reduce sort of residual leaching time and thus the need for vats, which could potentially impact the project footprint and the steel required for the vats and thus bring down capex. So that'll be something to watch. And the project is really divided into two dimensions, right? The first is the production of a mixed rare earth concentrate, the front end, and then there's the back end to separated oxides. So we'll have to see. But the company hasn't, as of today, spoken to any sort of major changes, and the changes that they have highlighted have been generally quite positive. The project continues to screen, therefore, as being one of the lowest cost prospective producers of rare earths in the West outside of China. And ultimately, I say it every time we have rainbow rare earth questions, but it's not a mine, right? This is an operation that treats byproducts of phosphoric acid production, right? Or phosphate fertilizer. And so therefore you have material that's organized in strips of phosphogypsum above surface that do not require mining. It does not require blasting. It does not require overburden movement. It does not require crushing such that, if you were to look at a hard rock deposit, the cost profile of just crushing that material is fairly substantial. So you have sort of, by virtue of the uniqueness of this deposit, you have innate cost advantages that put the project in a great position to be defensive should China ever choose to take action and sort of open the floodgates on the material to the world to disincentivize non-Western production. And you also have ability for really strong margin generation. As we expect to see continued increases in the rare earth prices into the future.
And again, you mentioned another company funded by the US government where they essentially got an off-take agreement where they have a fixed pricing. If we compare that to the expected sort of consensus pricing basket for Phalaborwa, if they would be able to score something similar with the US government, what would the impact be based on the latest?
Yeah. So the spot price today for NdPr, which is right around $80 to $90, and that's sort of a Chinese price, which is not totally indicative of what the actual price is here in the West. But if you were just to overlay the MP Materials deal and run spot for dysprosium and terbium, the heavies that are produced at Rainbow Rares, then you're looking at around $3 million per year of royalty income to Ecora. Now, if you compare that to broker forecasts, which I have here, the broker forecasts are running closer to spot, and that's around $2 million per year. But that's spot on the Chinese posted price, and there's a lot of if you were to look at the posted price for particularly the heavies in Europe, they're materially higher than the posted Chinese price, in part because of the export restrictions from China, where they're posted at that price, but end market participants are not able to actually transact and buy them at those price levels, which has created a bit of a bifurcation in rare earth prices, where you have a posted Chinese price, but then an actual price in the West for these materials. And I personally wouldn't be surprised as we move forward if you're really starting to see two price benchmarks emerge in a much more liquid and transparent way, being number one, sort of a Western price or European perhaps, and a Chinese posted price or ex-works price out of China, but not totally indicative of what may be required given the volumes are currently being restricted.
Yeah. I mean, you got two feasibility or pre-feasibility studies for both Nifty and Amapa. I guess maybe we can start with Nifty and check in on that as a bit more quickly, though, I guess. But use your key takeaways on that PFS and what the next steps are for Nifty.
Yeah, so in summary, Cyprium are at Nifty considering a two-step plan to bring this asset back into production. So the first is to reprocess existing heap leach material, and that creates early cash flow. The idea here is to turn that back on, and that is funded. Cyprium has raised $80 million Aussie, or is in the process of completing a financing, I should say, some of which has completed, but a large balance is not yet completed. That funding will be, as estimated by the company, sufficient to restart phase 1, 6,000 tons of capacity, and that's expected to run for 5 years, and Nifty is hoping to extend this. And then the larger project, which is particularly of interest to Ecora, is a $500 million capex to restart mining operations, and in over a 20 life produce over the 20 years on average just over 30,000 tons per year of copper contained in concentrate. Year 1 to 10, that's expected to be higher at approximately 39,000 tons per year. So Ecora's royalty triggers after 800,000 tons of contained copper are produced. And if you were to overlay the current forecasts as put out by Cyprium, that would trigger first production to Ecora in about 5 years. And that would be at $10,000 per ton copper, approximately $5-6 million per year.
Yeah. Okay. And you feel like what's been the communicated timeline to get things going?
Sorry, Gorm, what was that? I missed the question.
What has been their communicated timeline to get things going? What's the next steps for the asset? Obviously, it's a bit more long dated for Ecora and not the biggest royalty, but it's valuable.
Yeah, so the restart of the oxide circuit is estimated to be around $30 million. So that's a big chunk of the posted $80 million funding. The balance would be towards working capital, but also the completion of a DFS for the restart of the sulfide circuit and concentrate production. The company is targeting first production, I believe it's next year, from the oxide circuit, and then first production from a restarted larger mining operation 26-27. We'll have to see how things progress, but I have to say they have some real blue chip names supporting the company as anchors to the latest fundraise. It was really, I think, raising that capital in the market in the way they did with the shareholder base and some of the quality names, blue chip names in that registers, bodes well for the likelihood of this project coming into production.
Yeah, so they're more than fully financed to carry out the oxide small scale project, which is fairly insignificant, or doesn't matter for Ecora initially, but it matters because it gets them cash flow and gets them positioned to get to the full construction sort of situation.
Yeah, that's really the key right there, right? It creates a source of cash flow that can much more comfortably contribute towards the restart of a larger operation. It's very different sort of to starting a restart of a mine without any sort of incoming cash flow.
Okay, so Nifty is good. I mean, the updated FS, that will be sometime next year, then maybe mid next year, or had indicated when that will be for the restart.
It's possible. I don't have it to hand, but at the back of my mind, I've got it for sometime next year. I hope it's soon. I could be sooner, but Gorman will have to come back to you on that one.
Okay. I'll overlay that in a text here. You'll send me a message after this so people can see. And Amapa, again, you also got a PFS there. Just a reminder of what the takeaways from that PFS was, what's happened with the asset, and what are the next things to look out for.
Yeah, so I mean, just to set the scene a little bit for your viewers. So Amapa is a past producing mine, and that comprises of a historical mine, processing facility, a rail line, port, and beneficiation infrastructure. So the PFS contemplates the restart of that operation and refurbishing the historical infrastructure for a iron ore production of around 5.5 million tons per year, targeting Fe grades of 67.5%, which is a very high quality product, which is for direct reduction grade, which typically attracts grade premiums as a result of the purity. The mine life, as detailed in the PFS, was approximately 15 years, all-in costs of, call it $47 per ton, which compares very favorably to the 67% price today. Project capex estimated at just under 400 million, and NPV 10 of this project just under $2 billion. So this is something that is quite a big step forward, but that remains a PFS. And more studies are required for this project to ultimately come into production, which is why we thought a recent announcement is quite encouraging and quite exciting, actually, as a step forward to this project coming into production. Conceptually, not too dissimilar to what we just spoke about at Cyprium, actually. So the heads of terms has been signed for a $4.6 million funding package. And the idea here would be to restart the plant, the Azteca plant, and produce, on average, over the next couple of years, just under 400,000 tons of 65% product for 3 years anyways. That would come from retreating some tailings. So in other words, it wouldn't entail full restart of mining operations, but it importantly generates free cash flow. And that free cash flow can be used to part fund, and depending on the scale of the tailings reprocessing opportunity, could be more meaningfully contribute towards refunding the startup of the project.
So we covered all of the assets, at least in my view, gone through each individually, checked in. You had several positive developments, some of the big pieces on the chessboard, Santo Domingo, Mantos Blancos, Voisey Bay, and so on. And some new ones with PCE or SW2, Uranium Discovery, very interesting. And you also sold your Dugby gold royalty, came out of the blue, at least from my point of view, for $20 million US. That's great. But in the coming sort of 3-4 years, how do you view Ecora? I mean, what's the key sort of things you're looking forward to transpiring?
Yeah, I think in summary, Gorm, it's really Ecora becoming, from a revenue perspective, becoming aligned with what we have from a net asset value perspective. Right? We have a portfolio. We've invested heavily in developing exposures and growing our exposure to critical minerals, centered in base metals, copper at the core. But you don't see that yet, right? When you look at our revenue profile, a lot of that, less so this year and less so next year and so forth. But if you look at it maybe in 2024, you still see a large weighting from revenues to met coal. And I think this year, 2025, is on track for the first year in the history of Ecora to generate more of our revenue from the other assets in our portfolio than Kestrel. And next year, Kestrel is expected to be less than 20% of revenue, if you look at analyst forecasts. 2 years from now, copper is expected to be the number one contributor from a commodity perspective. Voisey's Bay, by royalty, would expect it to be the largest contributor just as an individual asset. And that's what I'm most excited to see, actually. We've assembled a portfolio that has really strong free cash flow generation potential via the royalty model over commodities that have really strong fundamentals. And it does feel as if we're really on the cusp of this portfolio demonstrating and starting to generate those cash flows. Starting today with the producing assets, we've spoken about the key ones, right? But in Mimbula, we've spoken about Voisey's Bay, we've spoken about Mantos Blancos, and these are all assets that are just are capable of doing more, just as a result of volume ramp ups from operations that are already in production, and beyond that, greenfield expansions. So in 2 to 3 years, I think those assets should hopefully have hit their stride and be running at sort of, call it steady state levels. And then we'll be at a time where you'll have that next wave of growth, right? And this portfolio, if you overlay the ability of this portfolio to generate, just from the assets we have today that are already in production, something like 50 million, depending on your commodity prices, and that's based on research analyst forecasts, commodity price fits in 5 years. On top of that, you have potential from the development assets to take it in excess of $100 million. So I'm really excited to see both those dimensions play out. In other words, number one, just the producing asset, ex-Kestrel, really demonstrating what it can do, and then beyond that, for key de-risking milestones on the next wave of growth from new assets just coming forward, and being able to have a much further view on when some of these assets will start materially contributing revenue for the business.
And not to mention, I mean, if you look at Voisey's Bay 5 years ago, how many positive surprises have you not seen in that asset in 5 years? And how much? So it's just like, yeah, some of these assets will continue to improve, I would expect. Not to mention those that are not currently in production but will be in production, sort of doubling the revenue outlook. And then again, right, because throughout this process, you're going to re-rate your cost of capital, and then you're able to hopefully also add more assets throughout that time more easily as well. which is so it's a very extremely interesting time for you guys. But I mean, I should also ask before we wrap up, sort of right now, how do you view Ecora's ability to sort of be proactive? You just had a liquidity event for 20 million bucks. You made the Mimbula acquisition. You have a decent amount of debt there, but you still have a fairly decent amount of flexibility to actually make more transactions if you wanted to. If you speak generally about what sort of opportunities you see out there right now.
Yeah, well, Ecora, relative to royalty companies of our market capitalization, generates a much outsized amount of free cash flow.
Yeah.
And this business actually, so we've put figures out in our H2, but this business does delever fairly quickly. In fact, we're on track to end this year with net debt levels subject to commodity prices anyways in H2. But if you assume broker consensus forecasts, roughly flat from where we started, open the year to where we finish, having pursued an acquisition of $50 million. That, of course, is also the Dugby sale, but still demonstrates that the business is just free cash flow and deleveraging capacity. I think in the shorter term, as we look through H2 and even in Q3, we should see continued deleveraging, continued flexibility. From a transaction side, we've spoken about the sort of three core areas of growth for this company, being just the ramp up of assets in production, number two, brownfield expansions at assets that are already in production, and then third, sort of greenfield, new assets coming online and incrementally creating new sources of royalty income. But we have not spoken about growing this business by virtue of buying new royalties. And that's definitely something we're looking to do in the future. We're still quite active in considering opportunities. And we're sort of patient. We're looking for our next deal of size to be one that's not too dissimilar to Mimbula, or in other words, assets that when we look at them, we are fairly confident, a good amount of confidence on their ability to diversify our sources of income within the next 5 years.
Perfect. I think we should leave it at that, and we've provided a generous update to people. I think it should be very well received, and I guess we'll probably speak. I mean, certainly sometime before year end. I would expect sort of probably perhaps sometime in early January or sometime early December. I think next time.
Sounds good. Look forward to it, Gorm.